Students, hi, Catherine Robertson here. We are in week 5 of our summer business 101 course. And I wanted to circle back through some of the material. So just a heads up, those of you that are new to the 4-week course structure or the 8-week course structure, weeks 4 and 5 are generally the tricky weeks. They are like the Wednesday of the semester, right? They are right in the middle. Also, the other complicating variable was the holiday weekend. So I do have a few of you that are a little bit behind on homework, and a few of you still that need to turn in your midterm exam. I will be updating the grade book, and so if you are a little bit behind, as I am in the grade book, checking work, please, if you are struggling too much, reach out to me so we can kind of make a plan, because we are in week 5 of the 8-week courses. Now this week, we are looking at chapters 9 and 10. And there are also 2 supplemental videos that go along with chapter 9 and 1 supplemental video that goes along with chapter 10. When you are looking at chapter 9 in the text, you will, once you read through the text and then you review the short PowerPoint kind of which highlights the main topics that I would like you to, glean from the chapter. A few of the things that are important in chapter 9, just as a highlight, is thinking about this idea of, so chapter 9, going back to that, finance, acquiring and using funds to maximize value. So as a business, whether you are small, sole proprietorship, or you are a large company, you are going to look for ways to acquire assets and to finance operations. And if you're a small company, you might be looking at loans from banks, you might be looking at direct contributions. If you're a larger publicly traded company, you're going to be looking at something like maybe issuing more stock, or also that credit that is supplied to you by suppliers, the net terms and things like that. That if and when you take our accounting, basic accounting class, you'll learn a little bit more about the importance of credit from suppliers. And really the idea for the financial area of the business in particular is to maximize the value of the firm. And one of the things that we talk about is this idea of risk return trade-off. So if you are looking at investments or looking at a new venture, really the bigger payout is usually attached to something that is more risky. And so the idea behind this, if you've ever thought about or heard about how folks bet on horse races, that is very much a risk return trade-off situation, right? The horse or horses that are by all accounts chosen to win the race, so there's 10 horses in the lot. If you bet on those, if you bet $1, we'll say you may, and you win, you may only win $1.50 back. You don't win much because there's not much risk there. So when you take that bet on one of the horses that's picked to win, they're already picked to win. So it's a low risk situation. Now, if there's a horse in among the horses that is not picked to win, or there's no details on it, usually you'll see, oh, that's 50-1, right? So if you bet on the most risky horse in the race, it's a good chance that you'll lose your money, right? But there is also the fact that it has the largest payout, right? And so when we look at the most risky investments, those are the ones that have the biggest payout. So when we think about the risk return trade-off, it's very important if we are a business and we are looking at new ventures, if we are going into the stock market or doing things which is more chapter 10, thinking about opportunities and rating them. The more risky they are, the bigger the payout, but also the higher the likelihood that it might not pay out at all. And so that's something that's important when we're thinking about our business operations and ventures, but also, which is chapter 9, but also in chapter 10 we start to talk about investments that you might be involved with. The other thing in chapter 9, we start to talk about financial ratio analysis. And one of the things that's key for businesses is this idea of liquidity. And so a liquid asset is any asset that can be easily converted into cash. And so what we saw during COVID actually were businesses that had high liquidity, and you can put that into a ratio format, but meant that they had lots of things. They either had a lot of cash on hand or a lot of assets that could quickly be converted to cash. Those businesses were able to kind of pay their short-term debts and pay their bills more easily than a firm that had most of their money tied up in less liquid assets. So that gives us a picture of a business and its financial structure, liquidity ratios. There's also other ratios that are important, such as leverage ratios, which measures, how much is the debt, how much is the business financed. So if the business is, we'll say, worth $100,000 overall, but if the business, 90,000 of that business is tied up in loans and other types of debt, then there's not much, it's not leveraged very well, meaning that most of the business is owned by other folks. Versus if you have a business that has no debt, there's lots of room there for, or very little debt, there's lots of room there for you to pull equity out of that business. And so that's something we talk about with leverage ratios. And asset management ratios is another one. When we think about, if two businesses have similar amount of their capital structure or the size of them, their worth is similar, but one business is able to actually produce a lot more revenue with the same amount, then what we see is, if we're looking at two businesses to invest in, or we're looking at our own business and how it stacks up against other businesses in the industry, how much or how efficient are you at your business at turning the resources you have into revenue, right? And so we look at two separate businesses, and one and they have similar assets, and one is turning a larger revenue. They're generating a lot more revenue. Something they're doing is more efficient. Their processes or what have you is more efficient than the similar sized business that is actually not producing that much revenue. So it tells us a little bit, these ratios tell us a little bit about how the firms are operating. The other thing that is important, thinking about things like a line of credit. Our business is able to get a line of credit if they get in a pinch. This is very important for small businesses, especially businesses that operate maybe seasonally, or they get large inventory drops. Having a line of credit to cover that. Also with trade credit, that's where we think about suppliers, and we think about, will the supplier drop off a bunch of inventory and not make us pay for it right away? So if the supplier drops off inventory and allows you to have some sort of net terms, you have time to recoup a lot of the payment by selling the items that the supplier has dropped off. So those are other parts of this idea of your financial picture as a business. Let's see, what else? And so thinking about some of most large companies, and actually all companies, they use the idea that, use other people or other, like banks to make money, use others' money to make money. And so there are pros and cons to that. There are pros to financing things, which many of us know on personal levels. Sometimes it's nicer to finance, but you are now paying interest rates, and you sometimes lose sight of the overall cost of an item. Right. And so this can be a tricky area, trying to figure out the pros and cons of borrowing money versus using money, either liquidating assets or using things like that to grow your business. And so, accounts receivable, again, acquiring funds has a lot to do with accounting. So as you take accounting classes and you learn a little bit more about that, Chapter 9 really ties into how businesses are operating and how they generate money, and how they're using the assets that they have. So there are two short videos that go along with Chapter 9, financial ratio analysis and how the stock market works. And then when we pop into Chapter 10, which also has a really, really great video attached to it, Warren Buffett, How to Invest for Beginners, it really starts to talk about Mr. Market and Benjamin Graham, Warren Buffett, one of our big, success stories when we think about investing here in this country. And some of the key tips that he has for those that are thinking about investing in the stock market. So Chapter 10 really gets into the idea of the markets. And, this is a whole area of study that you can study if you're interested in being more involved in the markets, or maybe you'd like to be a financial advisor. There are plenty of courses. We currently don't offer a specific finance course, but I'm working on it, right? I'm working on us having at least one financial course, maybe that focuses directly on the markets and market activity. So keep your eyes open for that as we grow. And so thinking about the different types, this whole idea of transferring money, the financial markets from savers to borrowers, right? If you think about a bank, that's how banks were first designed. They were designed that, a bunch of people put their money in there and they get a small interest rate for keeping their money in there. Other folks come in, that money that's pooled by all of the savers, borrowers borrow that money to either grow their business. If it's an individual, they might use it to buy a house. So the money is flowing in and out. This idea of transfer of funds from the savers to borrowers, and they're even locally, we see things like credit unions and savings and loans. We have a few credit unions. They operate much the same way. For larger companies, we see commercial banks that deal with large, typically typically publicly traded companies. But the other thing is, when we're looking at chapter 10 and you're reading through the chapter and then you pop over to the PowerPoint, you will see things relating to trading in the markets, and this idea of an institutional investor. An institutional investor is an investor that really amasses a large amount for an organization, we'll say, and they're managing, say, all of the pension funds for the Erie City School District, right? So they have maybe millions of dollars that they are able to then, hire folks or have folks manage that millions of dollars in a different way than if you or I wanted to go into the stock market and spend a few $1,000s and buy some stock. They have different opportunities. They also have different things that they can invest in that the average investor cannot invest in. There are a lot of laws, right? So when you look at the laws in chapter 10, a few things that happened actually less than 100 years ago, because the market has not been around that long. It's still unfolding as to the different laws that are established. The Federal Reserve System was Federal Reserve Act of 1913. That was initially established, and then we saw more on the heels of, or on the tail end of, or the middle of, really. But we had the 29 crash that was pretty unregulated, the stock market as well as banks. And now in 1933, a couple different acts were added in to try and prevent the crashing of the markets and prevent runs on banks, which is what happened during the crash of 29. And so in 1933, we saw something called the Banking Act, and then also the Securities Act, which ushered in the Securities and Exchange Commission, which is a governing body for, in particular, companies that are trying to go from private to publicly traded. And so now that is a pretty strict process that takes typically several years. If a company wants to go public, we'll say, or have an IPO, they need to do a whole laundry list of things, and the Securities and Exchange Commission oversees that. So just companies can't just jump in. They have to pass through several steps so that they are vetted properly before they are then released into the public to make them safer and more transparent. And so there are a couple that are more important to us. Most recently, Sarbanes-Oxley in 2002, and the Dodd-Frank Act. And so these two acts in particular really, 2002, we had a bunch of things happen in the late 90s, and 2002, then we finally had an act that kind of regulated financial statements a little bit better. I know, right? Turn of the century, and we still had fairly, loose, it was not really tight regulation for companies, publicly traded companies even. They were still how they release their financial statements, not only to auditors, but to investors in general. And then in 2010, after we had market issues in 08 and 09, and, we had this whole idea of the fiscal cliff, and we were, as a country, we were going to be downgraded in our credit rating, and all these different things that happened, and the market fell out because of the housing bubble. Different day, but the Dodd-Frank Act helped regulate some of the things that were happening to, we see on the heels of different crashes or different things happening, that then new acts are kind of put into place from the government standpoint, from a regulatory standpoint, to prevent whatever happens, right? So often we will see that if there is something that has been left unchecked and then it gets somewhat exploited or causes issues in our whole financial system, we then come up with some regulation the government does, and tries to prevent it from happening again. So that's kind of the process that we look at. And so chapter 10 really starts to talk about stocks and bonds, and the idea of how you might, it goes a little bit into bonds and how bonds are sold and how you buy them at a certain price and then you hold them, whether it's government bonds or other types of bonds, you buy them at a discount. So say somebody gives you a savings bond, they may pay $50 for it, and 20 years from now it's worth 500. So say you have a relative, and this may be something that you have, they gave you a $50 $50 or $500 bond, but they only paid $50 for it. And so that's the way the government, in particular, will raise money. So we will see federal bonds. We will see everything down to like a municipal bond. Like sometimes communities will issue bonds in order to raise money for a project maybe that they are working on. So the bond market, and then if you think about it, if you buy that $50 savings bond and it's worth 500 in the end in 20 years, what if you needed money out of that in the meantime? Right? So that's where the bond market comes into play. Someone may buy that from you at year 10. They wouldn't give you the full 500, but maybe they would give you 200. And so now they paid $200. They'll hold it for 10 years and they'll get 500 from it. And so the bond market can be anything from T-bills or short term for where something is only a few weeks and it's being traded, right? People need money, they sell their bond off prematurely, and then they can collect money and somebody else buys it. So that's a whole other marketplace, bond trading. That is a very interesting area. And so when we look at the securities market, everything you buy pretty much, like you and I, would be in the secondary, because the public offering is the only time you would see an initial offering of stock. And typically, to be invited to an IPO, you are a large bank, you're a top tier investor who will be invited to the table to these IPOs where you take on risk, right? Like when Facebook went, during most of us, probably in our lifetime, went public, there was a handful of folks that were invited to basically buy up the stock that was being issued as that company went public, from private to public. And then some of those folks immediately turned around and sold in the market. Some held it for a day, some held it for a week, some held it for an hour, whatever. And so that's the part that it's in the market as a secondary market once that initial IPO has been released. And those handful of folks that were invited to the table, or organizations, they turn around and sell their stock. And so that's what the rest of us, and then that people buy and sell that all the time. And that's that market that we're talking about. The securities market and the stock market is based on all of that secondary market. And we see, you know, that's typically where we'll be at from a personal investing side. There's different types of brokers that can help us. It's a little bit different now since the internet. 20 years ago, you always went to a person and they were the one that bought and sold for you. But now there's a lot of tools out there like E-Trade, Charles Schwab. Even like if you log into PayPal, you can buy little bits of stock. You can buy a slice of Bitcoin, all these different things. It's very DIY. A lot of the trading that goes on out there. And some of you may have those accounts and you do all of your own market orders or limit orders with those items. And you can do that right with E-Trade. So if you ever want to play around with E-Trade, you can set in their market order to buy at the best price current. So if you went into E-Trade, for instance, you could put in there, I'm going to buy 10 shares of Apple, whatever price is currently, there's a bunch of people selling Apple. Today, right now, what time is it? The markets are still open. So a bunch of people selling Apple, and they're selling it at different prices, and you want the current best price for 10 shares, and it'll just buy it if you set a market order. A limit order tells you to only buy, you can set in there, only buy the stock if it goes below a certain level, or to only sell your stock if it goes really high. So you don't even have to manage it. So maybe you bought Apple at $50 a long time ago, and you have set in there that your 10 shares of Apple that you bought at $50, in E-Trade, you can set in there, if it ever goes above 500, immediately sell it. So you don't have to watch the markets on any given day. You have this automatic system put in there. You can also do that with a broker. And so there are different types of strategies for investing in securities. So if you decide to become a financial advisor, or even if you're just thinking about for yourself, what are you looking for in the long run? Are you looking for Are you looking for investing? Are you looking for, are you investing for income? Do you want to buy things that generate steady income? Are you looking for market timing? Some people like to be day traders, right? And they are watching like what stocks are going where, and they're studying industries or studying companies, and they're trading on a regular basis, and that's what they're looking for as income. Investing for growth. There are some folks that like to invest in small startups and do things like that, and they are looking for this idea of I want to be on the ground floor of an organization. Fourth, value investing. Some folks will go right in, and Warren Buffett is famous for this one. Going in and investing in stocks that are undervalued. So studying the market and looking at an industry in particular, or looking at a company and realizing that this company is just not, it's not being priced right, right? The stock is way lower than other folks in the industry, and they should be holding their own in the industry. So that might be, if you value invest, it's a specific target that you have. And buying and holding stocks. So this is another one. Some people just buy, maybe they buy, Apple would be great. I'll go back to Apple. You just buy Apple and you know they're a steadfast company. Energy stocks, people like to do that. They just buy it and they hold it for the long run, right? Because the market overall is, even though it has its ups and downs, it generally is on an upward trajectory. And so buying and holding stocks, maybe you buy some stocks at age 20 and you plan to hold them until you retire at age 70. So that's buying and holding. So that's just 5 of, kind of general ways that you might invest. And it goes a little bit into that in the short videos. You've heard of the Dow Jones Industrial Average, and a lot of times you'll see that in the news. They'll just touch on that, track stock prices of 30 large, well-known corporations, U.S. corporations. So basically, is saying, are they growing? So in the Dow Jones, are these 30 large companies, like, is their stock going up? Standard and Poor is another way of looking. There's 500 companies. Are those companies then on the upward trajectory? And there's also then a list, if you look at Exhibit 10.2 of some of the major stock price indices. I told you the Dow Jones, Standard and Poor. We also have the NASDAQ Composite, the FTSE 100, FTSE, which is the London Stock Exchange, the Nikkei 225, which is 225 of the largest, most actively traded companies in Tokyo. And so when we're looking at those different stock indices, we have different trading areas throughout this. There's always something open, right? The U.S. Stock Exchange, or the New York Stock Exchange closes at 4:30 Eastern Standard Time, but then we see Europe is open. The way that the time changes work, that is something to consider when we're thinking about different markets that are being traded on their own time frame. So this was a little bit longer video than normal. However, then there's the homework from chapters 9 and 10 that's due this week, and that is the basis for week 5. Again, if you're struggling, if you want to, you could FaceTime me. I have a Zoom room. You can email, you can text, you have all of those things. Please reach out to me if you are doing fine. And I know that we have beautiful summer weather, then that is fine too. Just keep working along in chapter 5, and I will circle back with you later in the week. Have a wonderful rest of your day.